studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
In this section, we'll look at the most common types of income that are considered investment income when earned by a corporation. A corporation often accumulates surplus cash after paying its operating expenses and taxes. Instead of leaving that money sitting idle, it may invest those funds to generate additional income. The income earned from these investments is generally classified as investment income, also known as passive income. The first and perhaps the most common type is interest income. This includes interest earned from savings accounts, guaranteed investment certificates, commonly known as GICs, term deposits, bonds, or money loaned to others. Since the corporation is simply earning a return on its invested money, this is considered passive investment income. The second type is dividend income. Corporations often invest in shares of other corporations, mutual funds, or exchange-traded funds. When these investments distribute dividends, those payments are generally treated as investment income. As we'll see later, dividend income follows some unique tax rules, but it is still considered a form of investment income. The third category is capital gains. A capital gain arises when the corporation sells an investment, such as shares, mutual funds, or other capital assets, for more than its purchase price. Only a portion of the gain is taxable, but it is still classified as investment income for corporate tax purposes. The fourth common category is rental income. If a corporation owns real estate primarily as an investment and earns rental income from tenants, that income is generally considered investment income. However, as we'll discuss later, there are certain situations where rental income may instead be treated as active business income. A simple rule of thumb is this: if the corporation earns income from investing its money rather than from actively carrying on its business. For most owner-managed corporations, these four categories, interest income, dividend income, capital gains, and rental income, represent the vast majority of passive investment income. Learning to recognize these income types is an essential skill because each category has its own tax rules and reporting requirements within the Canadian corporate tax system. Although most rental income is considered investment income, there are several important exceptions where income that appears to be passive may actually be treated as active business income. As a tax preparer, recognizing these exceptions is essential because they can significantly change the corporation's tax treatment. The first exception involves a rental business that employs more than 5 full-time employees throughout the year. In this situation, the corporation is no longer simply collecting rent. Instead, it is operating a substantial rental business that requires ongoing management, maintenance, administration, and customer service. Because of this high level of business activity, the rental income may be treated as active business income rather than investment income. The second exception occurs when a corporation owns a property and rents it to a related operating company. Imagine a property holding company that owns a factory or office building, while a related corporation carries on an active business from that location. Since the property directly supports the active business of the related corporation, the rental income may also qualify as active business income under the tax rules. Another situation involves mixed-use properties. Sometimes, only part of a building is rented to a related operating company, while the remaining space is rented to unrelated tenants. In these cases, the income usually cannot be treated entirely one way or the other. Instead, it must be allocated between active business income and investment income based on how the property is actually used. These examples show that classifying income is not always straightforward. Two corporations may both earn rental income, but depending on the facts, one may report it as investment income while the other reports it as business income. The key lesson is that the nature of the activity, not simply the type of income, determines its tax treatment. Factors such as the number of employees, the relationship between corporations, and how the property is used all play an important role in determining the correct classification. As a tax preparer, you should never assume that all rental income is passive. Instead, carefully analyze the facts and circumstances of each situation before deciding whether the income should be reported as investment income or active business income. This careful classification is the foundation of accurate Canadian corporate tax preparation. When preparing a corporate tax return, one of the most important responsibilities is correctly identifying the source of each type of income. Before calculating any taxes, you should always ask one simple question: where did the income come from? If the income was earned by actively operating the business, such as selling products, providing services, or serving customers, it is generally classified as active business income. This type of income may qualify for the small business deduction and is usually taxed at lower corporate tax rates. However, if the income was earned by investing the corporation's money rather than carrying on its day-to-day business activities, it is generally classified as investment income. This includes income from interest-bearing investments, shares, rental properties, and other passive investments. The most common examples are interest income, earned from savings accounts, GICs, bonds, and term deposits; dividend income, received from investments in other corporations or mutual funds; rental income, earned from investment properties; and capital gains, realized when investments are sold for more than their original cost. There are also other types of income that may require additional analysis. For example, royalty income from patents, trademarks, books, or music may be considered investment income depending on the specific facts. Similarly, a corporation may temporarily invest excess working capital in short-term investments, such as GICs or money market funds, and the resulting income is generally treated as investment income. As you've already seen, some situations are more complex than others. Mixed-use properties, specified investment businesses, and related party rental arrangements require a careful review of the facts before deciding how the income should be classified. For most small owner-managed corporations, however, the classification process is usually straightforward. The majority of passive income falls into four main categories: interest, dividends, rental income, and capital gains. As a tax preparer, your workflow should always follow three simple steps. First, identify where the income came from. Second, classify the income correctly as either active business income or investment income. Finally, apply the appropriate corporate tax rules based on that classification. Developing this habit of identifying the source of income before performing any tax calculations will help you prepare accurate T2 corporate tax returns and avoid many common classification errors.